Mortgage rates dropped slightly on the back of the most recent CPI report that was released yesterday. Now, I wasn't expecting this. I was expecting mortgage rates to stay where they are or maybe go up slightly if the chances of a 25 basis points cut started to increase, which is what happened. Now, basically, the market is baking in a near 100% chance of a 25 basis point cut by the Federal Reserve at their meeting this month. What does this mean for the housing market? Well, first of all, it's good news for buyers, right? Buyers can get a mortgage at a cheaper rate. Purchasing a property is actually cheaper from a monthly payment perspective right now than it was this time last year because mortgage rates have come down significantly since last year. And we're quickly approaching 22 levels of monthly mortgage payment. So, what I expect to happen as a result of the Federal Reserve cutting their rates and as a result of the positive reaction from the CPI report is more buyers will eventually start to come into the housing market and sales in general will start to tick up. Now, I do think this will bring some sellers into the market as well as people who have locked into their low interest rates decide that rates are low enough where they'd consider giving up that low interest rate that they have on their starter home and purchasing another property. Now, something that's very important to note about the CPI data is that the main thing that's holding up CPI, that's keeping it above the Fed's 2% goal, is shelter inflation. If you watch this channel for a while, I've argued that if the Federal Reserve drops their Fed funds rate, that will cause shelter inflation to decrease, right? More people will be able to purchase properties. There will be less renters, and builders will have lower interest rates to bring more inventory to the market. All of those things are negative pressures on rates. And that being said, the current new lease rates that we're going to take a look at here out of Zillow are actually down year over year, if not flat year over year. So inflation that the Federal Reserve tracks, the owner's equivalent rent, is a lagging indicator. And so I think the market is taking a look at that and seeing that inflation is coming down, that the Federal Reserve will recognize that inflation is coming down, and it's time to start their rate cut cycle, which we've been talking about for a little while now. So before we get into this video, my name is Liam O'Reilly. I'm a realtor with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. Reach out to me directly. I would be happy to help you. So what we're going to take a look at first is the NFQ mortgage rates. I wanted to wait until today before making this video. I saw the rates drop yesterday after the CPI data came out. The best 30-year fixed rate mortgage you can get in Vermont is 5.75%. Those are for borrowers with the best credit. The high priority borrowers can get the best rate at New England Federal Credit Union. So not everybody is borrowing at the 5.75%, but this is down from the 5.875% that we saw earlier this week. Now, when we take a look at CPI here, we see that headline CPI year over year is up 2.5%, which is much lower. It's much closer to the Federal Reserve's 2% goal. And we take a look here at the core CPI, which is what is most influential to the Fed's decision. We see that core CPI is at 3.2% year over year and 0.3% month over month. This is the seasonally adjusted percentage change. Now, a big driver of that, the largest driver in CPI, is shelter inflation. It's rent of primary residence and owner's equivalent rent of primary residence. That accounts for 36% of the CPI number. So we see that shelter inflation was at 5.2%. Now, the Bureau of Labor Statistics has a different chart here that breaks out CPI from the shelter inflation. So what we're looking at now are CPI numbers without shelter. So when we take a look here, all items less shelter, if you just remove the shelter inflation, you see that CPI is at 1.1% year over year. So well below the Fed's 2% goal, meaning that things are slowing. And even if you take the Fed side and say that, look, shelter inflation is a lagging indicator, that data is not going to roll through the system and is not going to impact the CPI numbers for another 6 to 12 months from now, then still you would expect to see that shelter inflation will eventually come down, which will bring the CPI data down with it. Now, I do think if the Federal Reserve drops their interest rates, that will further reduce shelter inflation and we'll see things come down even faster. Now, when we take a look at Zillow, like I mentioned here at the beginning of this video, what this is are new leases that are advertised on Zillow, what these apartments are renting for when one tenant leaves and another tenant needs to occupy that space. So we see here the darker line is the 2024 numbers. The light blue line are 2023 rents. So we see the median rent across the country at the start of the year was actually down year over year. They were renting for about $100 less than last year. Now, as we roll through the year, we see these two lines have converged and rent is up slightly, or actually in September so far, rent has been even year over year. So a flat change in new rentals. The reason why the Federal Reserve doesn't only look at new rentals with their CPI data is this doesn't account for renewals, right? It doesn't account for people who are renewing their lease and signing up for another year at the same building that they're on. This data out of Zillow are only new rentals. So people that have moved out of one apartment and are moving, and then a new tenant is moving into that same apartment. It doesn't account for the rent renewals, which is what the Federal Reserve is trying to track when they look at this number. Now, something else with renewals is a lot of landlords keep their units under market rent for a significant amount of time. And then eventually, when they see what market rent is, they might try to jack up rents to be closer to market rent. Even if they're under market rent in a specific area, they might increase it significantly, assuming that there's no rental restrictions in their area to bring rents closer to market market rent, even for renewals. Now, one other thing that I wanted to mention in this video is as we talk about what is going to happen to the US housing market as a result of mortgage rates falling, assuming they continue to fall throughout this year, which is something I think will happen, is how will the housing market respond to that? Now, in one of my more recent videos, I talked about how buyers are at an all-time low, right? Mortgage purchase applications are at a 30-year low. There's almost nobody out there looking for a property. We see here in 1995, the mortgage purchase application rate was at 139, and we see the actual rate right now is at 138. We're basically at 1995 levels. So there's less buyers out there right now than there were even in 2012 or 2008 when everything came crashing down in the housing market. There's less buyers out there, but a big stipulation with the fact that there's less buyers is how low inventory is. If we take a look at this inventory chart from the past 40 years or so, we can see that although inventory is up year over year, it's been increasing across the country year over year, we're still under any point the past 40 years, excluding the most recent 4 years. So excluding from 2020 to 2024, where we are today, because that was the overheated housing market. That was when buyers were purchasing everything that hit the market. Homes were selling for well over list price. We all know that inventory was at historic lows during that time period. But to compare where inventory is now, because it's increased a lot since the pandemic craze. It's increased a lot, but it's still lower than any point over the past 40 years. If we take a look at 1995, which is where, or I guess this is December 94, again, it's right around where the mortgage purchase applications were at a 30-year low. So there weren't many buyers out there. We see inventory at that time was also fairly low, but it was still at 1.5 million homes. If we take a look at the homes on the market now, we see that as of July, which is the most recent data in this set, we're at 1.3 million homes. So there's not much inventory on the market. Now, why is that important for home prices? That's why we haven't seen home prices crash nationally. There isn't much inventory on the market. So although demand has decreased significantly, and in some areas, there's less demand than there is supply, right? Home inventory, there's more homes on the market than there are people who want to purchase those homes in some parts of the country. But throughout the entire nation as a whole, demand is starting to align with inventory levels, meaning that there's historically low demand, right? Lower demand, the lowest demand that we've seen in the past 30 years. At the same time, there's less inventory on the market than we've seen at any point over the past 40 years. So there's low demand, there's low supply, which is what is shifting the housing market right now. What's causing the housing market to turn into more of a balanced market as opposed to a seller's market or a buyer's market. So as mortgage rates start to fall towards the end of this year and into next year, I think we will see demand start to increase. But again, I mentioned at the beginning of this video that I do think supply will increase as well. And that's because people who have locked in their lower mortgage rates, maybe if you have a 4.5% mortgage rate and rates drop down to 5%, you might consider selling your starter home and purchasing another property, which would bring more inventory to the market. So overall, I expect home sales to start to increase as we move into 2025, as mortgage rates drop, I don't think there's going to be a drastic change in home price, either up or down. Of course, that could change if mortgage rates go back down to 3%. I do think we will see home prices shoot back up because of how little inventory we have on the market and how many more buyers will be able to purchase those properties at a lower monthly mortgage payment than we've seen this year. Now, I don't think that's likely. We aren't likely to see mortgage rates drop down to 3%, maybe ever. But if that does happen for whatever reason, I do think it will restart the housing craze that we saw over the past few years. So let me know what you guys thought about this video. Leave me a comment. I love reading your comments and learning from you folks. Thank you so much for watching, and I'll see you in the next video.